Okay, welcome to week 4, lecture 3. We're going to look at common size statements today. Common size statements. So common size statements, what we use them for is to compare one company to another. Canada, I read some places, a nation of benchmarkers, which means we compare things to other things. And in small business, that means we compare our company to other companies. And actually, not just us, but most companies do that, especially if you're a shareholder looking on the stock market to invest on something else. You look at benchmarks. Okay, our current ratio is actually 2 to 1. 2 to 1 is a benchmark, so kind of easy when you think of it that way. It's pretty easy to compare companies that are about the same size. We can just say, okay, this revenue and this revenue are about the same, so the expenses should be about the same. If one company is a lot larger or smaller, then it's a little tougher to compare. And how about if we want to look at our own company over time, which we assume we're doing okay and we're growing. So want to see how we did compared to last year. For this, we use something called common size. So the idea is we take a look at everything proportionally. Okay, proportionally. So we pick our accounts and say, okay, well, this compared to this gives us an idea if we can make them on some sort of an index or a proportional way of looking at things. The assumption being, of course, that bigger sales tie up bigger resources. Okay, and same thing with our own companies. Maybe it's gotten bigger or smaller, or maybe we're doing business differently, and that's something we need to measure and look at. Now in the previous slide the word proportional come up, and I want to point out that if you're going to take anything away from this, there's 3 things in this slide deck you should take away, and the first one is proportional. Okay, everything we're trying to figure out is to do with the idea of proportional in mind. Okay, so what we do is reduce the balance sheet and the income statement to common size numbers. Now, to me, common size is a bit of a misleading name. I don't know where accountants or financial analysis came up with this, except that what we're trying to do is reduce everything to some sort of a comparison factor or set of numbers. By doing this, we actually reduce things theoretically to a common size. What we do is reduce everything to a percentage of something. Okay, a percentage of something. So in the income statement, we compare or make it a percentage of all our expenses line by line to sales or revenue. So everything that gets declared as a percentage of sales or revenue, depending on what your income statement says. And on the balance sheet, we keep it simple. Everything's compared to total assets. So, and by the word compare, I mean mathematically speaking, we take one number and divide it by the other number. Okay, and this will give us a percent. So all of our assets line by line are a percentage of our total assets. All of our expenses line by line are a percentage of our revenue or sales. And by using our common size calculations, we can answer that question. Same idea with the balance sheet. Just common size everything compared to total assets. Okay, and we use total assets as a convention, i.e. it's a rule. You could use another number off the balance sheet, but there are reasons for not using other numbers, and we're just going to stick with total assets. It's the easiest to use. It's used by everybody. It's the simplest. So if you get tempted to use something else in the denominator, just stick with the total assets and you'll be right. Just a word to think about. Okay, so we got some things here. Notice the plant and equipment's 116% of total assets. Now, the plant and equipment, of course, that's the original purchase price. Okay, so we can see that every once in a while. We're going to have something like a long-term asset larger than the total assets. But when we take out the amortization, it brings things back down to a reasonable sort of view. I don't think there's any other big notes here. If we look at the accounts receivable, it's gone up a bit, but in terms of actual proportion, it's gone down. And again, we'll see this in the Excel file, just trying to give you an example of what's going on. Alright, some more quick terms. Current portion long-term debt. I think we already covered this, but seems to be something that comes up right about now again. So if I have a $200,000 mortgage, going to be paid over 20 years, the principal paid in the next 12 months might only be $10,000, might be $5,000, $8,000, depends how high the interest rates are and what it's set up as. So if it is $10,000 of principal that I'm going to pay back in the next 12 months, the current portion of that long-term debt is $10,000. And of course, the long-term portion is $190,000. And to pay off that loan, we would have blended payments, and we'd just give one lump payment, say, I don't know, $1,500, and $500 might be interest, and $1,000 might be principal. Or if we're going to use a $10,000 thing, probably $800, something like that would be principal. LTD equals long-term debt, just a reminder. And EBITDA is more of a cash-based approach to profits. It's basically EBIT plus the amortization added back in. When you watch TV shows like Report on Business and they talk about the stock market, this and that, and buyouts and analysis, a lot of the people on TV will look at the cash thrown off by the business, okay, before interest and taxes. Interest because that's a financing decision, not an actual running of the business. The investors will talk about a well-run company, and this is one of the ways they measure it. Taxes because we have to pay the government no matter what, as long as there's profits. And then amortization because amortization is not cash, okay? It's one of those, I'll call it a fake expense, and in one sense it is because it's not cash. In another sense, it is an expense because it's an allotment that lets us match our expenses with our revenue. Okay, so more of a cash-based approach to profits. That's all it is. We use this once, I think, later on in the break-even lecture, later in the course. And going somewhat back to lecture 2, in terms of finance, a loan and a lease are pretty much the same thing. Okay, in terms of the actual obligations and cash and interest and paying back principal and all that sort of thing. A lease is just a special type of loan. The difference is legally who owns the asset. Okay, if I buy a truck and take out a loan on it, the ownership says John's Moving Company or whatever it is, right on the card, I own it. If I lease it, I get it from the leasing company until the lease is paid off or until I'm done with the truck. The ownership on that truck says the leasing company's name on it. Now, at the end of the lease, I can buy it usually for like $10 or $100, something like that. But legally, the leasing company owns that truck, okay, until I decide to buy it at the end. Loan you buy it at the beginning, lease you buy it at the end. Dinner table conversation used to be leases were a lot easier to get the loans, but that's totally changed. So right now it's about the same. You have to fill out the same paperwork, do the same statements, put in the same guarantees, all that fun stuff, but eventually this is what you come up with. Loans equal lease. There are some financial or accounting or taxation benefits depending on what you're up to. Okay, earnings equals before interest taxes equals operating profit. And another thing on the balance sheet, common shares might be $1,000. That's the money from the shareholders that they invested in the company. Retained earnings, $1,500. That's money from operating, from profits that the owners have left in the company. Okay, the company's retained the profits or kept them. So we have total shareholder equity of $2,500, and that is the total investment by the shareholders. They've got their original investment plus any money they've left in there gives us a total shareholder equity. Okay, I'm going to do the blank example, the demo in week 4, Wally's, Biff's, and Barney's. I'll probably just do the first bit and let you go on the others. And so we'll do that.